So definitely appreciate you joining Adrian and I here today, Ian. Definitely it's been a crazy start to the year. So definitely appreciate you taking some time out of your busy schedule to be here, especially after was it a March break vacation that you were on?
Yeah, we are just down in Cali. Thankfully,
Okay.
it's not too far. Quick flight down there, and got some sun, so it was good.
Very nice,
Beautiful.
very nice. We could definitely use that now as spring's here and all that. So, Ian, I'm just going to give a quick little introduction to who you are and why we have you on here. Feel free to fill in any of the gaps that I'm going to leave. But at the end of the day, Ian Goodman, CFA, is our supervisor of managed accounts. He's our portfolio manager, deals with our unified managed accounts. And Ian was a big reason why Adrian and I chose to join Harbourfront and his team and the work that they do there. And just to give you a quick synopsis, I don't want this to be overly Harbourfront and investment specific, although we will touch a little bit on some of that a little bit later on. I want to get into a little bit more of the macro side, because I think a lot of the clients that we talk to on a daily basis are just really nervous about the state of the economy, what's happening. There's a lot of uncertainty around this. And one of the things that we really liked about yourself and the way that you manage money along with your team is the fact that you guys look at downside protection. So I'll let you get into what that actually means a little bit later. But I think that this is really Harbourfront's Super Bowl, right? Is when the uncertainty and the craziness and all of that is happening. I think this is really when you guys shine and do your best work. So really happy to have you on here. Really happy to be able to take a few minutes and just go over what is going on in this world. And just for everybody, this is not for investment purposes. So do not take any of this as advice and go out and implement it yourself. Please talk to an advisor. Myself, Adrian, or anyone at Cherry Hill would be happy to help you, or go speak to your advisor before you implement anything. So this is just for information purposes only. So I want to get that out of the way. So welcome. Appreciate you being here.
Thanks, guys. Good to be here. Yeah, lots of craziness with Trump policies, and trying to unwind those, unpack those, and figure out what is the boy crying wolf. What's going on there? Yeah. So
we can start right there. Like, how do you go about thinking about things in a situation where so much changes so quickly? I mean, it's frankly, it's dizzying. Even for people who are paying attention, I feel like it's a hard thing to keep a handle on what's actually going on from a day-to-day basis. And so then, you can't react to all of that different noise. So how do you manage change and manage the investments in a situation where everything's changing all the time, like it seems to be lately?
So, I mean, there's a few things yet to unpack there, but I mean, I think the first thing is that we try to follow a strategic asset allocation. So, like our core, 80% of our investments are invested in a strategic asset allocation, which means a certain amount, depending on your risk profile, is invested in equities, a certain amount in fixed income. If you're lower risk, a certain amount is, and then to diversify further, we've gone into the private world, which is probably another big reason why you guys came over. And so all our portfolios have an asset allocation which includes private securities, and those private securities, real estate, being apartment buildings in Canada, mortgages, infrastructure, and some private equity, and those securities have shown over the past 20, 30, 40 years, they're just a lot less volatile. So by having a strategic long-term asset allocation that we don't change, and we include those securities, it does take some of the volatility, and it doesn't, for those, we don't really, not so we don't care, but on the day to day when Trump's flying off the seat of his pants,
When does that ever happen, Ian?
those things just don't matter, dude.
I just keep refreshing my news feed, and it's something different every time.
Well, it's just tough, right? Like, just and then you don't know. I mean, is he going like far out as he can to try and get you to come to the middle, right? Yeah, it's
The art of the deal.
it's a lot of volatility, and And more so than the first, I think, than the first go around, right? The first go around, he was, probably a little more to the middle and the center, and he wanted to accomplish things. But now it's almost like he's pissed off for the last 4 years of not being there, and yeah, and looking to tear some of the things down, I think.
Yeah, it definitely seems like there's a bit of a vendetta for that, and somehow we found our way into this as Canadians, with being at the center of a lot of this. So I think one of the things, a lot of people are looking at this as this economic landscape is it just feels different, and we've been through crisis and the economic crisis, and we've had 2022, we've had like '08 and 00. Like there's been a lot of pretty bad markets over time.
Like the last 7 years, I mean, 2018, we had a 20% drawdown in 3 months. I was actually just looking at some stuff before I came on, and then 2020, and then 2022. So we've almost had like three mini, like, not 2022 was more prolonged, but 2018 and 2020, it's like we had two bear markets within, one within 2 months, and then, or sorry, 3 months, October, November, December, we dropped 2018, and then 2020, one month, like 30%. So, I mean, that just goes back again to having our strategic asset allocation where, long term, we do have money outside of public investments that just don't see that volatility.
Let's go there for a second. So we hear private markets. I think a lot of people still look at that as just this weird, scary thing that other people do that is, a lot more risky. And when you say private markets, what do you mean by that?
Well, I guess, I mean, really right now there's four main private asset classes. So real estate, and that can be just apartment buildings across Canada that, like the biggest holding that we invest with is Centurion Asset Management. They own about $6 billion worth of apartment buildings.
Okay.
They're managing those apartment buildings. They're collecting the rent. So they have professional teams that do all that. We'll invest alongside them. On average, over the past 15 years since they've been doing this, the returns range from 10 to 14, probably average around 12%. Much less volatile than equities.
And why is that?
Well, Canadian apartments, Canada as a country, it's been a place where people want to live. Strong democratic, good people. So people want to come here. So, the demand for homes in Canada is quite high. So that's been a strong anchor of our portfolios. You got private infrastructure. We all know people want to, not people, like, we're looking to get more green as a society. To do that, you need investments in, many different areas, renewable energy, maybe new bridges, cars, trains, like boats, everything, right? Needs to be apparently more fuel efficient. And if we want to do that, we got to, invest. So that's going to be kind of an upcoming, probably good area to be in. And the portfolios are starting to allocate more to the infrastructure. And then you got private credit, which is loans that are kind of outside of the tier one banking system. So, banks maybe don't want to lend to new immigrants. Banks don't, want to lend to some businesses. So there's other institutions that lend. I mean, we have, one of the biggest firms in the world, Blackstone, in our portfolio on the lending side. And one of the loans they did in the last, probably 12 months was a loan to NVIDIA. NVIDIA, we all know NVIDIA, growing like crazy, but, it's growing so fast that at times it runs out of cash. So Blackstone did a loan to NVIDIA so they could build more chips. And who bought those chips? And it was Microsoft. So they were backed by Microsoft. So, those are some of the private loans that are making their way into the portfolio. And then the last is private equity. That's sort of a smaller allocation. And that's just, firms that are not gone public. And, as regulation increased after the financial crisis, less firms are going public. So there's more private firms in the world than there are public firms. And I'm talking large size, large size firms that are growing, doing excellent business, but they just don't want to go public. So we're looking to, when we can, get investments to those too.
So you've kind of talked a little bit here about some of the things that are staples in the portfolio, and if the private markets are providing a lower volatility into the portfolios, is there like also a necessity for flexibility to be able to react to what's going on right now, or from your perspective, is that like overvalued if you set up right in the first place?
Yeah, that's a good question. We leave. So we have 80% that we kind of don't trade. We just leave it as it is. If equities go down, it's the equity portion of the portfolio will go down. But if we're wrong and we make a call, and move all that equities, and then Trump comes back like 2 days later and says, "Oh no, you know what? We're pulling the tariffs off," right? And the market jumps 4 or 5%. We just missed out on 4 or 5%. So we keep a core always invested. We don't make tactical decisions on those, and then 20% of the portfolio, we will make tactical decisions. And if we think we're going to a bear market, we'll reduce our equity and put that into fixed income and preserve capital and just collect income.
So how do you feel about it right now? I mean, the markets were down, a solid 10% there in the U.S. anyways for a little bit, come back in the last day or two. Is this a dead cat bounce? Do we all of a sudden, is there risk here we're worried about? Is this, a fairly normal move? Like, how are you feeling?
Yeah, so I think right now it's still uncertain where we're at. 10% drawdowns occur almost every second year.
Yeah.
And then like 80% of the time, the market finishes the year up. So we're still sort of uncertain, and let's just see where this rebound goes. And if it starts to fail and more risk look like it's coming on, then we'll probably be selling some equities in the next 2-3 weeks. However, if April 2nd, I've been reading that the tariffs might be delayed on certain goods for up to 6 months. That might be good news. So we'll see what happens.
Yeah, I guess that's most of what we're trying to get a hold on. I think here, like most people, I think are worried about what's going on in quote unquote the economy, because those are the words that we all tend to use in this industry, and especially the news media pushes that as well, like the economy, especially with an election being called here in Canada. Everybody's talking about the economy, but the markets aren't the economy, right? They're loosely correlated, but like the economy can do one thing, the markets can do another. Do you find that what's going on in the markets at the moment, like how closely tied is that to what's going on in the economy? And I think about it from a recession standpoint, right? Like there is this always a risk of a recession, but with tariffs and with these kinds of protectionist policies, maybe there's an enhanced risk of a recession. But a recession is an economic thing. We're mostly considered about the markets because we manage money, and those two things are, there's some separation there. Can you kind of chat about? So does that spark anything that you want to say?
No, I mean that's almost even like if we knew it was a recession and it was like clear, and the majority of stocks are say 90% of stocks went down, and it'd make our life a lot easier. But
Sure.
that's the tough part. The economy and the markets don't always align, and the economy can look weak and stocks can be going up. So stocks are somewhat trying to look future at future earnings,
Mm-hmm.
and then like maybe in the last 20 years, what are we 15 years maybe, ETFs have been created, and more money is just going into ETFs. So before that there was a lot of work that went on to analyze companies' earnings, analyze future, cash flows, and predict those things based on the economy. And now you've got a lot of just momentum, which is money just chasing, maybe the bigger companies like Google, Apple, Microsoft, Nvidia. So that can, you can see at times you can see where the economy is slowing down, and certain stocks are still working and going up because money is flowing in from maybe central banks printing or governments stimulating, which again it causes a disconnect. And so yeah, I mean where we're at right now is what I'm watching more more closely, I think, than tariffs is the government efficiency in the U.S. and how much they're going to be cutting.
And how does that affect investments and portfolios and all that? Like what specifically are you looking at from that? Is it just overall if they just go cut something really big, or is it just more
Yeah,
how many jobs?
Yeah, jobs. I mean that would be more tied probably to a recession and a general slowdown.
I guess like there's a lot of people that work for the U.S. government. Those people go and buy iPhones, right, amongst everybody else. And then I suppose also like a lot of people receive support from the U.S. government, for example. And if that support is then cut off, then they don't have their paychecks to be able to go out and do the things that they need to do. And my example is iPhones, but I mean it's just the same with groceries or anything else. Right? Like if people don't have money because now the government's not giving it to them, whether as employees or whether as seniors with their old age entitlements, that can really slow the economy down. I suppose that's kind of the direction you're thinking, or what you're thinking about.
Yeah, exactly. I mean, the last 4 years, the biggest net increase in employment was the U.S. government. So if they're going to cut, I mean, they're going to try and cut jobs, I think, and I mean they've been pretty blunt about it. We'll see what happens, but their hope is to spark the private sector and private sector and company growth. So in the short run, maybe we do have a recession and the stock market does sell off, and with the hope that it's going to spur on investments in the U.S. And so again, that's what concerns me more, and we'll see how this bounce goes here. And if we need to, we will reduce our equity exposure.
So, and is this more U.S. specific, just because of the whole Doge thing and everything that's happening there, or are we looking at more global kind of outlooks?
No, I mean alternatively, I think Germany just passed a fiscal spending bill. So it's interesting, right?
So there does seem to be a rotation towards Europe happening right now. Like the European markets are up a bunch.
It has, and it's been very, very aggressive, and it's almost. I mean, we'll see what happens, but again, when money just wants to flow in one direction, some of the valuations now on German stocks don't look so good. So you could easily see a pullback there, and maybe money flows back in the U.S. I don't know, but.
Do you think that? But you could also have momentum as a carrying, force in the European market, right? In the same way.
You could, yeah, you could. I mean, I think they passed a big stimulus bill, and then the other, kind of main, I think, idea is that if the Ukraine war ends, maybe Russian oil will be allowed to go back to Germany, and if they can get cheaper energy, then maybe their economy booms again.
Interesting. Yeah, it's there's a lot riding on a couple of these Middle East and then Russia, Ukraine, and what happens in a lot of these places as well. Because then I think right now we're as Canadians, I think, focused on the whole Buy Canadian thing, which is a great message. But what's going to happen with tariffs and some of these things that are a little bit closer to home. But there's also a lot of these other pieces of this very complex pie that's happening all around the world.
How do you see like the discussion around the interprovincial tariffs in Canada and moving product across the country? Do you see like I know there's supposed to be a benefit there if it actually happens. So have you thought anything more about that?
I honestly don't know too much about the interprovincial tariffs. I would say on a grander scale, Canada has a lot of resources. It'd be nice to see some collaboration, and maybe instead of shipping those goods elsewhere for other countries to refine and get into the process to build, that we maybe build some refineries in Canada and keep the resources here and take the profits, I guess.
Right. Sure.
But we'll see what happens.
And I think that's I think a lot of people when they're looking at the overall investments and what they are trying to accomplish and get the returns, protect the downside, all of that, there's no we don't know a lot more than what's out there, right? And I think, being able to have that flexibility, like you talked about, and also not react in this kind of buy sell on every single news piece that comes out is actually super boring, but also kind of like what the people with money do. The wealthy aren't going out and just like buying at every single or selling at every single news piece that comes out. Institutions are not doing that. Like that's just not how the rich stay rich, right? Like this is as boring as it is, have a good philosophy, have a strategic asset allocation, be able to move when you need to, but also not overreact to, every single time Trump gets in front of a microphone.
Yeah, I mean, agreed, and you just gotta I mean, you gotta understand that if the privates do what they're going to do and hold up, and even in a bad year, and on average, if those private companies say return 4%, and the other 60% goes down even 20%, you're only down 10%. I mean, it only sounds but you've preserved half your capital, and not even half. You're down 10%. You still got 90% of your capital, and when the market goes back up, it usually rebounds. I mean, even we've seen the last couple days or last week, I think it's up almost 5% now off the low, or 4%, right, on the SP 500, and that's in 3 days. And if you start missing it, then you're like, oh, then the psychology gets in your mind. And go, oh well, it'll bounce back, or it'll go back lower, and then I'll buy at the low. Well, meanwhile, it's just ripping higher, and you missed the 5 best days, and it's back higher than you sold, right?
The problem with trying to time the markets is you've got to do it twice.
That's
You
right.
got to get out at the right time, but you got to get back in at the right time too. And those are two opportunities to make mistakes, and most people cannot get those. You can't get either one of those correct, let alone both. So even professionals.
Yeah, professionals and clients, which is why we stick to our strategic asset allocation, and on the margin we might reduce some risk, but we're still if we took 15% of the market out of the stocks, we're trying to find something where we can still generate at least like a 5 or 6% return.
So I want to get into a little bit of what the Watermark private portfolios are and what we do specifically. I know we talked a little bit about some of the private assets and different aspects of that, but when we take a look and we talked about some of these recessionary periods, or maybe not even recessionary periods, but some of these pullbacks we've seen over the last few years, and one of the most recent is 2022, and I think most of us can remember that was a pretty bad year for both stocks and bonds. It was not good. If you were in kind of that 60-40 balanced portfolio, I haven't seen a mutual fund or ETF that was balanced, that was not down double digits. Basically, I think the best ones I've seen are like in that -9 or so, and a lot of them are in that -12 to 15%. Our portfolio managed to be up a little wee bit in that year on the balance side. So can you explain to me how that didn't lose money? Like why that philosophy works the way it does, and how it actually performs in kind of a year like that?
I mean, that year was almost easier than this year. Not like on the fixed income side, at least. So like the bond side, you saw the inflation, and we just knew like not to be in bonds. And if we wanted protection or just to be safe, that cash or cashable GICs, high interest savings, were paying 4 or 5%. So we allocated there and just took that inflation risk out. So on the fixed income side, it was a lot easier. On the equity side, it was tougher. We at times we still allocated to equities, and some of those went down, but again, having that 50% or 45% of the balance in our privates, which are almost do better when there's inflation, because the rents go higher, and the apartments, when you're loaning money and it's at floating rate, meaning the interest rate is readjusted every quarter, and interest rates are going higher, you get a higher return as the loaner. So those things did well for us. And where we are now, it's again, it's just more uncertainty like that. At least we were kind of certain there was inflation. Now it's, I mean, it's more uncertain. Are the tariffs going to last longer? If they last longer, there will be inflation. So bonds will go down. But if there's tariffs and there's inflation, does that cause a recession? So actually, interest rates should come down because the central banks need to lower interest rates. If we're like, it's going to be a lot tougher here. But again, having the asset allocation in 45-50% in privates, which will hold up, we probably will be okay again.
So I've kind of said it before that, like in my mind, the like the value of a security, the price of a security, is the kind of intrinsic value of the what that business produces, or the cash flows off that fixed income investment or whatever it is, plus greed minus fear.
Yeah.
Right. So you're basically taking the intrinsic value and you're adding a human emotion to it. And sometimes things are good and it's, everybody's greedy, and sometimes things are bad and everybody's fearful. And I guess my understanding of it, or at least the way I think about it, is private markets, you get rid of a whole lot of the greed and the fear. You still have the intrinsic value of the underlying investment, but now we're pegging that investment using professional analysis and chartered business valuators and a process to figure out whether the investment is up or down in value. It still goes up and down in value, but it doesn't get pulled so far up and so far down by both fear and greed. And so, I wonder if, like, when you think about the current market, like how much of it is things changing in the intrinsic value of businesses or loan portfolios or whatever, and how much of it is we're seeing a lot of greed or a lot of fear at the moment.
On the public equity side, we
Yeah.
probably saw a lot of. I mean, we've seen a lot of greed off of '08, right? 2008. We're probably still in that bull market, like on a long-term 15-year basis, with the quick pullback in 2018, the quick pullback of COVID. We had a longer one last year, but the market's still in a very long uptrend. So there's a lot of people that are still bullish, and still think Trump will pivot, and Trump's pro market, and central banks will save us. So on the larger scale, we're probably, I mean, we've had the pullback 10%, but maybe valuations can still come in a little bit more. And then on the private investment side, like you said, most of those things are marked to the intrinsic value. Going back to like the Centurion, the guys that do the apartment buildings, if they don't have any new buildings to buy, or they don't think that buildings are the right value, they won't buy those buildings, and they just shut down for investment. So you cannot invest with, like, they'll shut down for 6 months saying we're not taking capital because we can't find anywhere we want to allocate that we think is worth the intrinsic value. So that's kind of how they hold their value, which is us being invested with those guys from for the last 6 years. When they do open up, if they're closed, we're usually the first guys they call.
So you literally can't invest unless the opportunities are good. So you're almost prevented from making a mistake in that way, in a couple of different ways.
Yeah. It's actually it's pretty neat being on the investor side, invest in something that, hey, we can't find any good opportunities right now, so we're just going to shut down. Not shut down, but we're just going to take a pause.
Right.
And I think that's the nice thing about the private side as opposed to the public side, is that they're able to do that a lot easier, right? Whereas on the public side, whether it's equities or REITs or whatever it is, there's certain obligations to the shareholders that are maybe a little bit different than on the private side.
Yeah. I mean, the public side, I mean, everybody can just hit your buy button and you buy. It doesn't matter what the price is. Oh, it goes up $5. Perfect, I'll sell. But really, like, you're buying something that maybe the valuation is already overvalued.
I think you get, like, for example, public mutual funds. Like, if there's a bunch of investors chasing returns into a public mutual fund and there's money going in there, they have to buy too as well. Right? So
they have to take that money and buy.
Yeah. So the portfolio manager that's running that mutual fund could be going like, there's no way I'd be allocating capital if I didn't have to right now. Maybe you've got like other investment managers are sitting on the sidelines, but you're managing this mutual fund with cash flows coming in. You don't have a choice. You have to buy into a market that you don't want to be buying in. Where I suppose on the private market side of things, they just go like, nope, we're just going to hold on. This is not where we want to be. Kind of the Warren Buffett approach, right? He's got so much cash for a reason. He could allocate it, but he doesn't want to.
Yeah, he's sitting on, a lot of cash right now.
Yeah.
And
yeah, interesting.
And the patriot he is, he won't admit that he doesn't want to buy stocks right now. I just but yeah, their mandate is that they have to be fully invested, so they go out and buy. And if they're a U.S. only fund, they got to buy only in the U.S. They can't, even if they'll think Europe is better. Then, and that's another reason why we just prefer to use, when we do invest, we do use global equities.
Just for more global.
Yeah, so we believe more in global equities, and the if the manager is a good global investment manager or investment management firm, and they will find the opportunity no matter where it is in the in the world. So if US is maybe US is not looking good right now, and they think Europe's better, they maybe they'll allocate a little bit, and if they should be 50 US and 50 rest of the world, maybe they'll take it 40 to 60. And swing the other way. So that's one of the benefits of being in a global mandate. But the globalization, the whole world is usually pretty tied now.
So right now, we talked about a lot of the risks that are out there, and I think you open up any news feed and you can see a lot of those. And what's leading you towards, what are you seeing that's still that light at the end of the tunnel? Like where are the opportunities, or that thing that's out there that's going, maybe it's not so bad, or does that exist?
No, you just don't know with Trump, right? I mean, if governments continue to spend, the economies need to grow, right? So companies, and then innovative companies will always do well. There's new companies coming on and doing great things. It's sometimes harder to find those companies because they're usually smaller, but that's part of the private equity that we have. On the flip side, on the public side, if things don't look well, and we do go in a recession, well then maybe it should be a good year for bonds, and there's some good bond managers that we have kind of in the bullpen that we're looking at, and hopefully if equities come down here, and maybe fixed income can have a 7, 8, 9% year.
Sounds like some of those on the private credit side, that's kind of where they are a lot of times as well, as far as returns on the private income side. So.
Yeah, some of the better private credits that we have access to now. Some of the years they're shooting 10, 12%. When you're loaning to NVIDIA for 90 days and probably getting a 5% return on 90 days, like, when NVIDIA is getting a 75% return, they can pay the 5% for 90 days or 3% or whatever it is, right? So there are opportunities out there.
Corporations are going to, like, their businesses, they're out there to sniff out opportunity and make money. And I think, honestly, those private equities are, tend to be more nimble, right? Because they're, less beholden to the quarterly earnings report and more able to say, like, okay, there's an opportunity here now that didn't exist before. We're going to go for it. Or we're going to close up that piece of business because, whatever, ABC reason. But they tend to be, I think, more nimble because they just don't have to answer to the public in the same way. They have to answer to their investors, which are not the public, and can take a very different approach to, what's a good opportunity and what's a risky opportunity. And I think there's potentially some opportunity there with just, when things move quickly, private companies can move quickly too. Just look at how many companies, all of a sudden can make masks in a hurry in 2020.
Yeah, I was going to say our private equity PM is fairly bullish this year with lots of change and thinks that mergers and acquisitions might pick up, and that would be a good environment for private equity returns to do well.
I suppose lower interest rates too, right? Rates are down. Like that's helpful, I would think, for private equity investing as well.
Yeah. More lower borrowing costs.
Yeah, exactly. Yeah.
Ian, I don't have a whole lot else. Anything you want to kind of leave, just like what should investors be doing right now? Like any words of wisdom for those out there that are,
Yeah, I mean, remain calm, review your risk tolerance. If the past like month has been challenging for you, then perhaps maybe your tolerance for risk is less than you think. I mean, when markets are going up, everybody's happy, but if you're stressing over a 10% drawdown, then review your risk profile and maybe see where you are. Talk to your investment advisor. If you're in a growth or more equity, then maybe that's not suitable for you. And in a year, if things are different, then maybe you go back. But it's probably the best thing to do, and that just means taking a few chips off the table and still being invested, but just in a different asset allocation. Maybe a little bit more privates and a little bit more fixed income.
Yep, and I think investors who aren't in managed product as well, like for example, the Watermark portfolios that you're taking care of for them, you'll be careful that the portfolio doesn't move over time with a strong bull market, right? You could get in as a balanced investor very intentionally, and it can pull you towards growth over 4 or 5 year bull market, and then when that inevitably turns around, you're actually overexposed to the risk that you didn't want to be exposed to because of the market pulling you in that direction.
Yeah, it's just, I mean,
just classic argument for
well,
rebalancing.
most people, you get a little things start going your way, you just get a little overconfident, right?
Right, sure.
let's keep riding it.
Yeah.
Right.
Yeah. But again, if it's the last month was too much, then yeah, look at taking a little bit of risk off, and then you'll sleep better at night.
The pillow factor. Perfect.
Yeah.
Yeah. Yeah. No, I definitely agree. Yeah. Appreciate you coming and spending some time with us here today. It was, definitely good. Every time I talk to you, it puts my mind at ease, just knowing that, you're managing, a good swath of our book and our clients, take care of them, through the retirements and kind of all their life's goals, and helping them get there in one piece without, all the crazy volatility. Obviously we still see a little bit of it, but it just doesn't seem like it ebbs and flows quite the same way as the rest of the world. So definitely appreciate you and all that you do for us and our clients.
Yeah, we appreciate it, and thank you for your support and your confidence in us. And I guess one last point too is that those private returns, they do take a full year to materialize. So sometimes when if we're down 5 or 6% because the equities have dropped in a month, well, our privates, at the end of the year, the returns will be there.
Perfect.
Yeah, and that's one of the things that I've noticed on Y charts recently is that now we're tracking on a daily basis, whereas previously it was month end, everything was updated. So it does definitely take a little bit just having those private assets that don't report quite as frequently as everything else. That it does kind of get there, just a little bit slower. Which is built into what it's supposed to do, right? Which is why we're not seeing the daily volatility as well.
Yeah. Yeah.
Yeah, perfect. Thanks, guys.
All right.
Thanks, Ian. Thanks, Adrian.
Thanks.
Thanks,
All right,
everybody.
thanks.